Beginning in the 1990s, deregulation and advances in technology led to an explosion of complex financial products called derivatives. Economists and bankers claimed they made markets safer, but instead, they made them unstable.
Since the end of the Cold War, a lot of former physicists, mathematicians decided to apply their skills not on Cold War technology, but on financial markets. And together with investment bankers and hedge funds.
Creating different weapons.
Absolutely. As Warren Buffett said, weapons of mass destruction.
Regulators, politicians, and business people did not take seriously the threat of financial innovation on the stability of the financial system.
Using derivatives, bankers could gamble on virtually anything. They could bet on the rise or fall of oil prices, the bankruptcy of a company, even the weather. By the late 1990s, derivatives were a $50 trillion unregulated market. In May of 1998, the CFTC issued a proposal to regulate derivatives. Clinton's Treasury Department had an immediate response. SEC Chairman Arthur Levitt issued a joint statement condemning Bourne and recommending legislation to keep derivatives unregulated.
Regulation of derivatives transactions that are privately negotiated by professionals is unnecessary.
In December of 2000, Congress passed the Commodity Futures Modernization Act. Written with the help of financial industry lobbyists, it banned the regulation of derivatives.
Once that was done, it was off to the races. And the use of derivatives and financial innovation exploded dramatically after 2000.
The old system, when a homeowner paid their mortgage every month, the money went to their local lender. And since mortgages took decades to repay, lenders were careful. In the new system, lenders sold the mortgages to investment banks. The investment banks combined thousands of mortgages and other loans, including car loans, student loans, and credit card debt, to create complex derivatives called collateralized debt obligations, or CDOs. The investment banks then sold the CDOs to investors. Now, when homeowners paid their mortgages, the money went to investors all over the world. The investment banks paid rating agencies to evaluate the CDOs, and many of them were given a AAA rating, which is the highest possible investment grade. This made CDOs popular with retirement funds, which could only purchase highly rated securities. This system was a ticking time bomb. Lenders didn't care anymore about whether a borrower could repay, so they started making riskier loans. The investment banks didn't care either. The more CDOs they sold, the higher their profits. And the rating agencies, which were paid by the investment banks, had no liability if their ratings of CDOs proved wrong. Suddenly, hundreds of billions of dollars a year were flowing through the securitization chain. Since anyone could get a mortgage, home purchases and housing prices skyrocketed. The result was the biggest financial bubble in history. There was another ticking time bomb in the financial system, called credit default swaps. For investors who owned CDOs, credit default swaps worked like an insurance policy. An investor who purchased a credit default swap paid AIG a quarterly premium. If the CDO went bad, AIG promised to pay the investor for their losses. But unlike regular insurance, speculators could also buy credit default swaps from AIG in order to bet against CDOs they didn't own.
In insurance, you can only insure something you own. Let's say you and I own property. I own a house. I can only insure that house once. The derivatives universe essentially enables anybody to actually insure that house. So you could insure that, somebody else could do that, so 50 people might insure my house. So what happens is, if my house burns down, now the number of losses in the system becomes proportionately larger.
Since credit default swaps were unregulated, AIG didn't have to put aside any money to cover potential losses. Instead, AIG paid its employees huge cash bonuses as soon as contracts were signed. But if the CDOs later went bad, AIG would be on the hook.